The Dow above 14,000 for the first time since 2007. What does that mean? We kick off this special coverage right now. Harry Dent is with me of HS Dent Investment Management. Scott Wren from Wells Fargo Advisors. Lee Munson from Portfolio Asset Management. Stephanie Link, a CNBC contributor from the street. Good to see everybody. Thank you so much for joining us.
Thanks, Maria.
Scott Wren, let me kick this off with you. What is behind this move in stocks?
Well, I tell you, Maria, this year's off to a lot better start. I don't know if you heard the applause in the background when the bell rang, but people are happy. We're at 14,000, a touch over. I think the market, myself, not to put a damper on things, I think the market's a little ahead of itself. I think it's going to be higher than this at year end, but right now this is a pretty darn good jump from December 31st till now.
It sure is. The question is, does it keep going? Harry Dent, where are you on this?
Yeah, Maria, we've been looking for the market to go higher in about mid-year. I'm looking at about 1,600 or near on the S&P, 15,000 or near on the Dow. I think before you get there, though, you do get a more substantial pullback before you get a likely top. So, I mean, right now, things are good. We got over the fiscal cliff. We knew we would rally after that. I don't see this rally going to major heights this year or a lot higher because earnings are decelerating and now interest rates are rising. Long-term rates are rising despite QE3 being so strong. So I think we're getting near the end of this, but I do think we got a good bit to go first.
Okay, so in other words, ride it up until you think that, what is it going to be, the catalyst that actually sends this market lower? We know that there's no great shakes to talk about with the economy. Sure, we have a better situation in housing and corporate cash is strong, but we're still got real pockets and real issues and uncertainties.
Yeah, no, there are. I mean, there's uncertainty in Europe. I mean, Robert Schiller was saying even the housing rally doesn't look as strong to him as people think. He's surveying actual customers rather than just speculators, saying people aren't really that much more bullish on housing. So even this housing thing may not have the legs people think.
Yeah, but that, Harry, even if the housing doesn't have the thing, it's still improving off a low base. We still got jobless rates going down. And quite frankly, I think QE3 is working. And as long as we don't have jobless rates go below 6.5, the Fed's going to pump up this thing like an old athlete on steroids. So I still think if we get
rates are up 60 basis points despite QE3. Yeah, that's not working if rates are going up.
No, those are long rates only, and that's because we have less risk aversion out there. People want to have more risky assets. Maybe long rates have bottomed, but it doesn't mean that this isn't helping commercial banking system heal and start getting the money velocity working.
Stephanie Link, what do you think? Tell us how you see things here. We're at 14,009 and change with a gain of 1%. How do you think next week plays out?
Well, it's interesting. So many people are looking for a correction. So many people are trying to pick at the negatives. And I'm not sure you're going to get this major correction that everybody's looking for because, quite honestly,
that's part of the problem.
Wait a second. But the point of it is that the reason is because the data is actually getting better. If you look at all of the U.S. data this week, durable goods, pending home sales, Case-Shiller, CoreLogic, ISM, across the board, even the GDP and even the non-farm payroll numbers today, there are a lot of interesting data points under the surface that are actually showing things are getting better. And Maria, you said before to Herb that don't fight the Fed. It's working, clearly. Now you also have China doing a little bit better, 50 on the PMI overnight. Europe had the best PMI in 9 months. So not everything is perfect, and I certainly think that we are going to see a volatility. But everyone's talking about a correction, and I think at the end of the day, the facts are things are getting better. And oh, by the way, earnings are running at about 5%. That's different from the third quarter when we saw negative 5%. So I would actually say earnings are not decelerating. They're actually in the bottoming process and headed higher.
What about that, Scott? You said it's decelerating.
Well, I tell you, I think that earnings are only going to be up about 5% this year. We're at that point of the cycle. I think that all the things that Stephanie mentioned are true, but all that means to me is that the economy's moving ahead at 2 or 2.5% growth rate. I mean, that's nothing to write home about. Valuations aren't going to be pushed up higher on a PE basis when you've got, you're expecting 2 or 2.5% growth. Nobody's going to run up these PEs big time this year, I don't think. I hope Harry's right. I'd love to see a correction. I think it's an opportunity. I don't know what the catalyst is. I hope it is this government negotiations over the sequestration. I mean, give me a 5 or 10% correction. I'd love it. We'd be pounding the table in there to buy stocks.
That's, you know, I'm out here in San Diego at the TD Ameritrade conference. We got like 1,000 or so big advisors who handle hundreds of billions of dollars for wealthy Americans all over. They're first of all, Maria, they're all 55 and up. They're all baby boomers, and they're all mad that, you know, when they see a 6 GDP and now it's 2 or 3, they're thinking it's negative 2 or 3 because it's not like the 80s, it's not like the 90s, and they're frustrated. They want in. They want some correction to happen. I asked my buddies who are bears, what's going to happen? They're like, I don't see a catalyst. So the problem is that I don't think that we're going to get something that's going to bring it all down so everybody can dump their useless managed futures funds that they've been in so they can go back and buy stock. They're frustrated. They want in. Market goes higher because of it.
What do you want to be exposed to then? I mean, let's say this continues higher, Lee. I mean, where do you want to be exposed? Is the leadership that took us here going to be the leadership that takes us even farther?
Most likely, but I think that you have to stick in the United States right now. I still think that Europe, I mean, some people think it's going to be, 12 months. I think it might be 24 months. I'm not that bullish, but I still think if you stick in the United States, be broad-based, man, just buy the S&P 500. Make it easy on yourself because Uncle Ben is making it easy for everybody. And I think that if you want to be in tech, be in tech. And commodities, only thing I like is copper. Outside of that, even our emerging market position, which is overweight, I'm thinking about paring that down in the next couple weeks.
Well, what about corporate bonds? Go ahead, Stephanie.
Well, I was just going to say, if you listen to a lot of the conference calls, some of the companies and industries that you would think that would be lagging, like the industrials, because they are exposed to the global economy, they're actually doing quite well. So I think that that group is one that you want to be involved in. I think that financials are certainly an area where you want and could be leaders given the housing boom and given that they're starting to lend again. 5% on average loan growth in the quarter from this industry. So I like that group too.
Next week, what are the catalysts that we need to be aware of in terms of taking this market even further up?
Next week, actually, we get another slew of earnings. 17% of the S&P 500, they're going to be reporting next week. So you get companies like Yum Brands. We're going to get a good read on China and just international markets. But Eaton and Emerson, those companies, Disney, News Corp. So we're going to get more of a global read, I think, next week. That will be important.
All right, we'll leave it there. Thanks, everybody. Appreciate your time tonight. We'll keep watching this market.
Thank you.
Teflon market, really. Thank you. We'll see you soon. Have a great weekend.